Hi, I'm James Massey from Grace Loans. So good to be with you today. I'd like to talk for a moment about comparison rates. Oftentimes, as you see a loan advertised, they will have the interest rate that is being offered for that loan, but they'll show with it a comparison rate, and quite often that comparison rate is significantly more than the headline rate. What is the difference between the two? Well, the headline rate, the first rate that you'll see, is the actual interest rate that they're charging. That's the interest rate that's being calculated on your loan balance. That goes out of the payments that you're putting in. It covers the cost of that loan. But there might be other fees that are associated with the loan. There might be an upfront fee. There might be ongoing fees. And how do those affect the overall cost of the loan? Well, the comparison rate is designed to be able to help you compare one loan with another one. It works in all of those fees and charges and works out what the equivalent interest rate would be if you're paying no fees or charges. But there's a catch. This is based on a loan of $150,000 over 25 years. Now, if you are borrowing double the amount, let's say $300,000, then the impact of the fees is only half of what it would be for the $150,000 loan. And therefore, the fees and charges don't add that much to the interest rate, to the equivalent interest rate. So really, you need more than a comparison rate to compare loans. You need to actually work out what the difference is. Now, there's another issue that you want to think about as well that's related to this. And that is, are you going to keep that one loan for the entire 25 or 30 years? Or is it likely that you're actually going to change loans along the way? Now, banks have an uncanny ability to make interest rates climb up over time. They'll be offering 3% or whatever it might be, some beautiful low rate for a new person coming in to get a home loan. But their existing customers might be paying 0.5% more or maybe even a full percent more on some occasions. And the banks are quite happily taking that in. And of course, how it got there was over the time as interest rates went up and down, the banks would not pass on the full interest rate cuts and they'd add on a little bit more if the rate is going up, and they allow that interest rate to creep up over time. So chances are you're going to want to change every 3 or 4 or 5 years, depending on what's happening, to get a different loan with a different lender. And that adds a whole different aspect to this picture of comparing loans. Because in actual fact, you don't want to compare the loan over the entire potential length of the loan if you kept it forever. What you really want to compare is the likely period of time that you're going to keep that loan and which one is the lowest cost during that period of time. So that might mean that the one with a low interest rate, but the annual fees might be the one to have at the start. And then towards the end, you might want to change the one that has no fees, maybe a slightly higher interest rate. Well, it sounds complicated, but we're here to help you to work that out, to try and help you discover the loan that's going to be best for you. So give us a call today. Make an appointment to talk with Beth and work out what the loan is that's going to really suit your situation and help you get out of debt as soon as possible.